Alright, hi everyone. Welcome to today's pre-market live analysis brought to you by IC Markets. Alright, we'll be starting very shortly. I just want to make sure you guys can see my screen, which is the first page of the presentation slides, IC Markets webinar, pre-market live analysis. And just like to know you guys can hear me well. Audio is all good. Do take note, I've got the live chat box open as well, so do not hesitate to drop any requests for any current analysis that you'd like to see, as well as any questions during today's webinar. Alright, good evening, Ren. Good to see you again. Pound, euro, for sure. A pound, dollar, yes, of course, we'll get to that. Yeah, definitely. We'll start off, as usual, by looking at some of the key economic events for this week. Then we'll start the analysis with the dollar index, and of course then we'll flow on into the rest of the currency pairs, right? Alright, okay, so let's get things going. Alright, it's time to start, but as usual, before we kick things off, do take note of the disclaimer. Right, this is market communication and does not contain and should not be construed as containing investment advice or investment recommendation or an offer of or solicitation for the transactions in financial instruments. Also, take note of the risk warning that comes with trading forex and CFDs. They carry a high level of risk to your capital, and you should only trade with money you can afford to lose. Alright, so here's the agenda for today. As I mentioned, we'll start off with a quick review of the key events coming up this week. What are the key economic data releases that we should take note of? And then, of course, we'll dive into the charts and trading view and do the analysis on the major currency pairs, any crosses that you may have, as well as gold, commodities such as gold and oil, and perhaps even the indices too. Alright, so my name is Ketan Rameshchandra. So this webinar series is brought to you in a special partnership between IC Markets Global and Everest Fortune Group, where we have been the finalists for Best FX and Equity Research for the following years, 2019, 2020 and 2021. Right, so this calendar is from Forex Factory, right? Do take note, I'm on GMT time here. So we've got quite a few important economic events coming up this week. Alright, good morning, Philip. Good afternoon, Philip, rather. Good to see you. Alright, hi, aloha. Great. Thank you, everyone. Alright, so yeah, as you can see, the calendar is pretty heavy this week. But I'd just like to point out we've got US CPI data coming up on Tuesday, the 13th of February at 1:30 p.m. GMT time. We've also got UK CPI data as well coming up Wednesday 14th, 7 a.m. Then we've also got US retail sales, UK GDP as well. So there's quite a few important events coming up, most notably with the inflation data from the US and the UK. So if you look at US inflation data, right, this is my slide here shows the chart on the left for headline CPI, the chart on the right shows core CPI. So as you can see, since pretty much the middle of 2022, both of these indices, CPI indices, have started to trend lower. Right, we can see the headline CPI peaking at 9.1% in June of 2022 and has started and has since eased quite considerably with the latest reading, which is December's reading, coming in at 3.4%. Similarly, core CPI peaked at 6.6% in September of 2022 and has proceeded to slow down quite rapidly as well, with the latest reading coming in at 3.9% in December. So you can see, although inflation is trending lower, heading in the right direction, the rate of change is slowing down, but it's well above the Fed's target of 2%, right? The Federal Reserve has an inflation target of 2% year over year, and clearly the current CPI readings for headline and core are still well above their target of 2%. So although inflation is slowing down, the rate of change has slowed down, but is still higher than the target. So we can expect the Fed to at least maintain rates at current levels, because they want to be sure that inflation truly is heading lower and is well anchored as well. Right, if we look at PCE, which is another inflation index in the US. This is something that the Federal Reserve watches very closely as well. This is the personal consumption expenditure index. So similarly, on the left I have the headline reading, and on the right I have the core reading. So they are both trending lower, right, which is great. But as you can see, 2.6 and 2.9% is still slightly above the target of 2. All right, next on the chart here, so what can we expect for January's CPI figure? Well, if you look on this chart here, on the blue line I have the CPI year over year change, which is this chart here, right? This chart here, as you can see, 9.1% CPI peaked at 9.1% in June of 2022, and December's reading is at 3.4. So that's what this blue chart is showing here. But the red chart is the average of the ISM prices index. So the ISM report is basically a PMI report, right? Purchasing Managers Index report. So in that report, for the manufacturing sector and services sector, they have a prices index as well. So it basically measures the level of inflation in the manufacturing sector as well as the services sector of the US. So what the red line is showing is the average of this ISM prices. If you look closely here, we can see that over time since 1997, the ISM prices, the line in red, tends to increase or drop in advance of the CPI data. So what this means is the ISM prices index generally has showed us the direction of US inflation over time. So as you can see here, in November of 2008, ISM prices started to rise quite quickly, and after that CPI data followed suit, right? Similarly, as ISM prices fell down in July of 2011, CPI prices then tended to drop lower as well. Similarly here in 2015, we can see ISM prices rising quite strongly first, followed by CPI data. So what this is showing us over time since 1997, for most periods of time, the ISM prices index has actually led the increases in CPI data. So as you could see here in 2020, ISM prices was rising very rapidly well before CPI started to rise, and then similarly when ISM prices sort of stalled and started to reverse to drop lower, CPI started to follow suit a few months later as well. So in most of the time, the ISM prices index has been a good indicator or leading indicator of where inflation could be headed. So what we see here for the latest ISM prices reading for the month of January is actually heading higher again, right? So on the left is the ISM prices index, right, which is measured on a scale of 0 to 100. It's starting to go increase again. It's going towards 60, and on the right we have the scale for CPI, which is at 3.4%. So now on Tuesday, right, we have January's CPI data going to be released. So because ISM prices have started to move higher, and over time we can see that ISM prices tends to lead the CPI data, so it's quite likely we may see headline CPI in the US head higher as well. So headline CPI is expected to head higher. That means inflation could be returning back in the US, and that means the Federal Reserve is likely to maintain a hawkish monetary policy stance. So they may not be continuing to raise rates aggressively, but they're likely to keep it at current levels for an extended period of time. So basically what this means is we could have a very strong bullish catalyst for the US dollar following the CPI data that's going to be released on Tuesday, right? So do take note of that. All right, hi Roy, great to see you as well. All right, Horace, thanks everyone for tuning in. All right, and that brings us to UK inflation as well. Similarly, on the left I have the chart for headline CPI, on the right I have the chart for the core CPI. Clearly the headline reading of 4% year over year and the core reading of 5.1% year over year is well above the Bank of England's inflation target of 2 to 3%, right? The Bank of England also has an inflation target which is 2 to 3%, and quite clearly the current inflation levels in the UK are well above their target. So similarly, the Bank of England may not be aggressively increase their rates, their official bank rate, but they're likely to hold it at current levels so as to make sure that inflation truly is continuing to slow down, right? The rate of change for inflation should continue to slow down. They want to make sure that continues to slow down, so they're going to keep rates higher. So we could see A potential bullish catalyst for the pound as well on Wednesday should CPI data come in hotter than expected, right? So do take note of that. And we've also got GDP data in the UK. Since you can see the GDP growth rate, the chart on the left, economic growth in the UK has been pretty subdued or pretty anemic, right? It's not been growing strongly over the last few quarters, but however, we do see the last 3 months strong PMI data being presented. So since November, December, January, we have seen a figure of above 50. So when PMI data is above 50, right, this indicates expansion in the services and manufacturing sectors of the UK. So since we've seen a pretty strong expansion figures over the last 3 months, we could see the next GDP data come in probably a little bit better than expected. So do take note, we may have a case where we've got slightly higher than expected inflation data from the UK plus slightly stronger GDP data or GDP growth that could cause or create a bullish catalyst for the pound on Wednesday, right? So do take note of that. So we've got, just going back to the calendar, we've got CPI data in the UK on Wednesday and followed by GDP data on Thursday. So Wednesday and Thursday we have two potential bullish catalysts for the pound, and on Tuesday we have US CPI data, which this is also once again could be a potential bullish catalyst for the US dollar. All right. Okay, so with that, let's quickly dive over to the charts on TradingView and see where the key levels are for this week. All right. So here I am on the chart for the dollar index, right? I'm on the daily time frame, right? So as you can see, from the end of December 2023, we have seen a strong increase in the value of the dollar index, and naturally we've seen strong demand for the dollar, right? So the dollar index dropped as low as 100.53 back on 28th of December, but since then it's risen as high as 104.60 in 2024, right? So we've seen strong moves in the dollar index. We've also seen extended periods of consolidation. So you can see since the end of December till 5th of Jan, we had a strong move up in the dollar index, and then we can see it sort of consolidated over the next few days before moving another leg higher and then consolidating again. And now we've had very recently, of course, as we started the month of February, we saw another leg higher as well, and price does seem to be consolidating again now, right? So do take note, this 104.50, the region of 104.50 is a very strong resistance area for price for the dollar index, right? We saw this level here, price hit this level here back in 8th of December before continuing to drop lower, and once again it does seem to have run into resistance around the same area, right? So if we do get stronger than expected inflation data in the US on Tuesday, we are quite likely to see the dollar index move towards the first resistance at 104.72 or perhaps even break above it, right? So maybe as we kick things off today, right, maybe the dollar will continue to consolidate around 104, right? But should we see a much hotter than expected CPI data on Tuesday, we are likely to see the dollar index move up at least towards the first resistance and perhaps even break through that first resistance, right? Similarly, if we get softer than expected inflation data, we may see the dollar sell off, but based on what we've seen on the ISM prices index, it seems like it's quite likely inflation is going to come in probably a little hotter than expected. But regardless, do take note, these are the key levels for the dollar index. We've got an intermediate resistance level at 104.27, right? This was the peak that occurred on 8th of December. We've also got another the main resistance coming in at 104.72, right? We can see that this level here in the past, where's my brush, right, has acted as resistance, right? We can see price running into resistance here, making a swing high resistance on 31st of May 2023, and then running into resistance here again on 8th of September, right? Roughly, you can see price didn't respect this level as good or as cleanly as it did back in May, but you can see generally when price after breaking above this level finding support here on 12th of September as well as on 20th of September, right? So this level then started to proceed to function as a support level, thus creating an overlap. So now, of course, with price breaking under here, but you can quite clearly see price has run into resistance once more in February as well. Right, so this quite clearly is a very significant level at 104.72, which is why we've identified it as the first resistance. This is actually an overlap resistance that also aligns very well with the 61.8% Fibonacci retracement, right? We also have a 61.8% Fibonacci retracement level that aligns very well with the first resistance. So we started this retracement from here, right? We started the retracement from here, 3rd of October, and ending with the low here on the 28th of December, right? So that's how we've got the second first resistance and the 61.8 Fibonacci retracement. Right, now let's just say hypothetically this week we see price breaking above the first resistance at 104.72 due to higher than expected inflation. Where could the next resistance level be? Right, I would highlight it over here. If we look across this price level here at approximately 106, right, we do see a case for a pretty decent overlap resistance as well, right? Back in 30th of October, 31st of October, price finding strong support here for a couple of days before dropping lower, and then as price broke underneath it and started to retrace higher, it ran into resistance once more on the 10th of February. So you can see that this then creates a pretty significant overlap level here at 106. So that's why we're going to use this level to help us identify the second resistance for the dollar index. So do take note, second resistance is at 106.06 here. Right, and then moving down, we also have an intermediate support level at 103.60. Right, this level here also aligns quite well with the, this is 23% Fibonacci retracement. Okay, let me try to be sure. This is 23. Yes, it is a 23.6% Fibonacci retracement. So we started this retracement from this low here on the 28th of December, and of course going to the high of last week, which was on the 5th of Feb, right? So, and we can see here price running into resistance here, right? When price was consolidating, consolidating from 17th of Jan to 1st of February, right? So almost a period of 2 weeks. Price failed to break above this level here. So this level was previously acting as resistance, but of course with price breaking above it, this level at 103.61 now could potentially function as an intermediate pullback support level, right? So that's why we've highlighted it in the green dotted line. Right, the first major support for the dollar index comes in at 102.71. Right, once again you can see price finding very strong support here on 29th of November, 28th of November, 29th of November, and of course price proceeded to break underneath here, but as it retraced higher, you can see running into resistance again, right? So since 3rd of Jan till 15th of Jan, once again period of almost 2 weeks, price failed to climb above this level here, so thus this created an overlap resistance level at 102.71. But of course with price trading above it now, this overlap resistance level could now potentially function as an overlap support, and we do see that support coming in again, right? As last week on in the back end of January, 24th of Jan, price coming very close to this level before reversing to go higher. So you can see that price has acted as a pretty decent support level back on 24th of Jan as well, right? So that's how we've identified the first support for the dollar index. And of course should price break lower, it could find support around here. We do see a pretty decent support level here at 102.075, right? Price finding strong support here from 3rd of January till 12th of Jan before breaking higher here, right? So do take note, these are the key support and resistance levels for the dollar index. We may see, at least for today, the dollar index continuing to consolidate around 104 or perhaps even slide lower. But come Tuesday, and if we do see a hotter than expected inflation data, we are likely to see demand for the US dollar come in a big way and push dollar index at least all the way up towards the first resistance at 104.72. So do take note, we've got CPI data coming out in the US on Tuesday, and should we see a very higher than expected figure, that's of course going to push demand for the dollar up, and we are likely to see the dollar index move up higher. Alright, so with that, let's now move over to the euro and the pound. We'll cover the other majors as well. and then we'll look at oil, gold, and anything else that you would like to like me to cover, right? So do not hesitate to drop your request for any analysis that you would like to see for the currency pairs, the majors or crosses in the chat box, and I'll be more than happy to go through the analysis with you. All right, okay, so let's move on over to the euro. So similarly, if we've seen the dollar index climb very strongly for most parts of this year, right, then we're going to see the euro slide lower as well, right? So this is what we are seeing from the end of December as well, right? 28th of December, the euro went as high as 1.1139, right, touching a high of 1.1139 before reversing to drop lower. So you can even see here, price has been trading in a bearish channel pretty much since the 2nd of Jan, right? Price does seem to have respected the upper and lower bounds of this bearish channel, and today, of course, if we see, especially over the last Friday, with dollar index pulling back slightly, of course the euro, that means euro is going to be heading higher. So where that resistance could come in is at 1.08 excuse me, 1.0821, right? So it's quite likely the euro, at least for today, may push a little bit higher towards this pullback resistance level here at 1.0821. And we've also labeled this level as an upside confirmation, meaning that if price breaks above this level, it could give us a potential bullish confirmation for further upside movement, right? This level here also aligns quite well with the 23.6% Fibonacci retracement, and price also found strong support here back on 23rd of Jan to 1st of February. You can see this level here has acted as pretty decent support level. So what was previously a support level could now potentially function as a pullback resistance. Similarly, the second resistance is up top here at 1.0992, right? We can see price running into resistance here, making a pretty decent swing high resistance back on 29th of November, right? This is a pretty significant swing high resistance, price finding resistance at 1.0992. Then of course finding resistance once more here on, what is this date? This is the 14th and 15th of December, right? Finding resistance once more. Then of course when price broke underneath it in early January, as it retraced higher, you can see it ran into resistance once on 5th of Jan, then again on the 11th of Jan before proceeding to drop lower. So you can see the price action of this level has created a very significant overlap level, which is why 1.09.92 is we've identified this level as our second resistance for the euro. Right, to the downside, right, we see this price level here at 1.0736. This is basically the first support, but we can see that we've identified it as labeled it as a downside confirmation. So similarly, should the euro break under 1.0736, is likely to trigger a move all the way down to the second support here. So I'm just going to label this more clearly. This is the second support. So why is the first downside confirmation or the first support level significant? If you look here, similarly, price running into resistance here back on 6th of November, price making a very significant swing low bounce of this level again on 8th of December. So this creates a very significant overlap level. We had resistance here in early November 2023, then we found support in mid-December 2023. So this creates a very strong overlap support, which clearly price has respected last week, right? Price finding strong support on 5th and 6th of February to retrace slightly higher here. So you can see quite clearly how this level here has functioned, truly has functioned as a very significant overlap support for the euro. But however, if we've got CPI data coming out in the US, so if we get stronger than expected CPI data, we're likely to see the euro demand for the US dollar pick up. So that means the euro is likely to fall and break underneath this downside confirmation to trigger the move, a potential move all the way down towards the second support at 1.0665. So do take note, these are the key support and resistance levels for the euro. Alright, Roy, yeah, we'll cover Aussie as well. Alright, okay, there's also a request for US 30, so that's Dow Jones 30. Yep, we'll cover that as well for sure. Right, we've seen the S&P 500 hit all-time highs again, breaking above the key threshold of 5,000. Right, we finally had the first daily close on the S&P 500 above 5,000. So equity markets have pushed much higher as well in recent times. So yeah, we'll cover that as well. Great to see the request come in. right? So this is what we have for the euro. So do take note, these are the key resistance and support levels, and of course the release of the US CPI data is going to play a big role in the direction of currency markets this week, right? Okay, we had a request for the pound as well from Brent, so let's cover the pound and then I'll slide on over into the Aussie after that. Okay, when we look at the pound and euro, right, we can see despite the strength in US dollar in recent weeks, the pound has actually held up quite well, right? We can see here for the dollar index, it's been rising quite strongly since the end of December, right? But when we look at the euro price, when we look at the pound, pardon me, the pound has been quite resilient, right? Despite a overall stronger dollar since the end of December, the pound actually has ranged or was ranging approximately between 1.2630 and 1.28, right? You can see since the end of December up till 2nd of February, price was ranging between these two levels despite stronger demand for the US dollar, but the pound finally gave way on the 5th of February, dropping as low as 1.25 before once again reversing to retrace a little bit higher, right? So second resistance is quite clear, 1.2789, right? You can see price finding support here on 27th of July. After that, it ran into resistance several times in August and in September, for most parts of August before dropping lower. So this creates overlap level where price once again ran into resistance here on 15th of December and running into resistance here 28th of December. Okay, we can see here 27, 28 with prices breaking above this level, but generally you can see that 1.2790 you can say has acted as pretty strong resistance for most parts of this year as well. So that's how we've identified the second resistance. Is a pretty significant overlap level at 1.2789. Similarly, the level here at 1.2632 was functioning as strong support, right? In 22nd December, early Jan, right at the beginning of Jan, and in 17th of Jan as well. And also you can see here on 1st of Feb price finding support as well. So this level here was previously functioning as a pullback support level, which is what 1.2632, but of course with prices breaking underneath it, this level now is quite likely to function as a pullback resistance, which is what we've seen over the last few days, right? Price has come close to this level on 7th of Feb, 8th and 9th, but has yet to break above this level convincingly so far. So do take note that 1.2632 is indeed a pretty significant pullback resistance level for the pound. And then on the support side, right, we've also have this other overlap level here at 1.25, and we can see prices running into resistance here on 14th of November. Then when price broke above it, it found pretty good support as well on 22nd November, 23rd of November before bouncing higher. So this then creates an overlap support level where price once again respected it on 8th of December, 13th December before bouncing higher, right? So you can see quite clearly this is a very significant overlap support level for the pound, and we saw this level being tested last week, at the beginning of last week as well, prices coming down close to this level before reversing to go higher again. So this is quite clearly a significant overlap level, which is why we've identified it as the first support, and we can also see that's a 38.2% Fibonacci retracement here. So we started this retracement from this low here on the 4th of October and ending with the high over here, which was on the 28th of December. So you can see the 38.2% Fibonacci retracement aligns quite well with where the first support has been identified. Similarly, the second support at 1.2379 is also another overlap level here, right? Price you can see making a pretty decent swing high resistance here on 6th of November, and then when price broke above it, it found good support on 17th of November before bouncing higher. So this creates an overlap level, right, which is what we're identifying as the second support. So similarly, the pound, we can expect a pretty volatile week for the pound, right? We've got US CPI data, UK CPI data, as well as GDP data, which is likely going to push and pull the direction of the pound. So on Tuesday, we could potentially see the pound drop lower if we get hotter than expected US inflation data. And we could see the pound test the level of 1.2501 once more. Then conversely, on Wednesday and Thursday, when we get UK CPI data on Wednesday and GDP data on Thursday, if we see stronger than expected figures, we could see demand for the pound return, and that could mean we could see it potentially break above the first resistance of 1.2632. So do take note, the US inflation data as well as UK inflation data and GDP data is likely to create a pretty volatile week for the pound, right? Especially from Tuesday onwards. Tuesday, Wednesday, Thursday, we could see the pound being pushed and pulled in both directions. All right, so do take note of that. All right, hi Laith, there's a request for gold. For sure, we'll cover that as well. All right, so these are the key levels for the pound, and do take note of how the US and UK inflation data as well as UK GDP data is likely to impact the direction of this currency pair. All right, let's move on over to the Aussie. All right, because we've seen the dollar index rise strongly in 2024, then naturally we're likely to see the Aussie pull back quite sharply as well, which is what we've seen, right? After hitting a high of 60, 68, 66 back at the end of December, the Aussie has been in a strong downturn, right? Going as low as 64, 67 on 5th of Feb, right? At the beginning of last week. Prices falling as low as 64, 67. So it does, for most of last week, we can argue that prices has been ranging, right? Price for the Aussie has ranged approximately between 64.80 and 65.30, right? We can see that over the last 5 trading days, there's not been any clear direction, right? When we saw prices falling sharply at the end of December, and then in early Jan, we saw prices consolidate for a while, right? Before taking another leg lower, dropping another leg lower. Then it consolidated again roughly between 65.50 and 66.15 for nearly 10 trading days, right? Almost 2 weeks. And then taking another leg lower again. So once again, the price is consolidating between 64.80 and about 65.30 for most parts of last week. So we could see the Aussie attempt to break above this first resistance at the beginning of this week, but do take note, we've got inflation data out on Tuesday, so we may see the Aussie drop another leg lower, right? So we could see the Aussie on Tuesday fall towards the first support and even potentially break under this level as well, right? Okay, so why is the first support a significant level, right? We can see price finding decent support here on 16th of November, 17th of November before moving higher, and as prices return down towards this level, we can clearly see it finding support on Monday as well. Last Monday, in the beginning of last week, 5th February, price found strong support of this level and has managed to stay above it. So this is quite clearly a very significant pullback support level, which also aligns quite close to the 78.6% Fibonacci retracement. So we started this retracement here from this low on the 10th of November and ending with the high here on the 28th of December, right? We can see that the 78.6% Fibonacci retracement level aligns quite well with where the first support has been, right? And second support is also quite clear, right? We see price making a very significant swing low here, right? This is a pretty significant swing low bounce, right? Price reacting off 63.50 very strongly before bouncing higher. And that's how we've identified the second support at 63.49, which is this very significant swing low support here. To the upside, first resistance, when we look at 65.26, is also a pretty significant overlap level, right? Price finding support here on 3rd of August. Then you can see since end of August till 15th November, price finding strong resistance as well, right? So this creates an overlap, a significant overlap level here, but of course price broke above it, but once again proceeded to find support at this level here on 22nd November, 7th December, and we can even argue 13th December finding support just above it before moving higher. Similarly, on the way back down, it found strong support here on 17th Jan, 18th Jan, before retracing a little bit higher and then falling once again. So you can see quite clearly that 65.26 is indeed a very significant overlap level, which is why we're using it to identify it as the first resistance. Similarly, the second resistance at 66.13 is a significant pullback resistance level here, right? We can see since 22nd of Jan all the way till even 2nd of February, price has failed to convincingly break above this level here, right? And this level also aligns quite well with the 38.2% Fibonacci retracement. So we started this retracement here from the high on 28th of December, ending with the low here, which was on the 5th of February. And we can see that this retracement at 38.2% aligns quite well with where the first resistance, with where the second resistance at 66.13 has been identified, right? So do take note, these are the key support and resistance levels for the Aussie on the daily time frame. All right, okay. Hi, Kubeib. Yeah, we're coming to gold now. All right, I see a couple of requests for gold. So yeah, right. Let's move on to gold now. All right. Okay, so here I am on the daily time frame for gold. So if we look at prices, price action since 12th of January, we can argue that gold has been trading in a sideways range, right? We can see it's failed to move above $2,055 per ounce convincingly since then, and it has found strong support at 2006. So we can see that this, we can argue that price actually has been in a sideways range for gold, right? Clearly failing to break above 2055, and also of course finding strong support at 2006, right? So you can quite clearly see that gold has been ranging between these two levels since 11th of January, and it's quite likely to do so over here. We've not seen a major move up or down for gold prices since 15th of January. So over the last 2 weeks, we've not seen a clear direction for gold prices over the last 2 weeks. It's actually been range bound trading, and it does look like it's going to fall, continue to fall lower today, especially if the demand for the dollar picks up on Tuesday, right? So do take note, first support is pretty significant. Why is that? Right, we see price making a pretty significant swing high here, right? You can see price making a pretty swing high resistance here on 27th of October, and then also making another resistance here on 6th November before dropping lower, right? So this is a pretty significant pullback or swing high resistance level here. And then of course price broke underneath this level here on 12th mid-December, but you can see it found strong support here 17th of Jan. You can even argue here 25th of Jan finding support again. So this overlap level here is indeed pretty significant, and that's why we've identified 2006.30 as the first support. Similarly, the second support here is a very strong pullback support level, right? You can see price as it fell sharply, reversing here to bounce higher. So you can see that this is a very significant swing low bounce as well, right? You can argue the price action here does look like to be a pretty significant swing low, and that is why we're using this level to identify it as the second support, right? It's at 1977.81, which is also a level that aligns very well with the 50% Fibonacci retracement. So we started this retracement here from this low on the 6th of October and ending with the high here on the 4th of December, right? So we can see the 50% Fibonacci retracement aligns very well with the swing low here. All right, okay, U-shaped recovery, right? Okay, Dick, all right. Alright, okay, Dick, yeah, I'll cover the dollar index again. I think you may have missed that part. Okay, no worries. I'll come back to the dollar index and the euro once I'm done with gold. Alright? Okay, so these are the key support levels for gold prices. To the upside, right, as I mentioned, since 12th of Jan, prices failed to break above 2055. Gold is been in a sideways trading action since then. So first resistance is quite clear here at 2054. Second resistance is this level here. So if I zoom out a little bit, right, you can see that this second resistance at 2075 is indeed a very significant level here, right? You can see price making a very significant swing high resistance here on August 2020, another swing high resistance here on 9th of March 2022, and even you can argue here as well, price coming quite close to this level on May of 2023 before running into resistance, right? So you can see quite clearly price making three significant swing high resistances since July 2020. and even here now coming back to where price is currently trading, right? You can see, of course, on 4th of December, price breaking above this level here, but failing to close above it, right? And even here on what is 27 and 28 December, price once again running into resistance around this level before proceeding to drop lower. So you can see quite clearly 2075 to 2090 is indeed a very significant resistance zone for gold prices here. So that's why we've identified second resistance at 2075.28. Right, okay, is there any Fibonacci retracement levels I could use? Let me see. I think there may be a retracement here. Let's see if there is one. Is there a 61 perhaps? I think there might be. Right, so we've also got a 61% Fibonacci retracement. So I started this retracement here from 4th of December, going down to this low here on the 13th of December. Right, you can see where the 61.8% Fibonacci retracement level lies is also a strong resistance zone here, right? You can see price coming exactly up to the 61.8% Fibonacci retracement. Of course, the candles didn't close above it, the bodies of the candle didn't close above this thing, but we do see the wicks breaking above it, but failing to close above it convincingly. So you can see indeed that the region of 2090 to 2075 is indeed a very strong resistance area for gold prices. All right, so do take note. So if we get stronger than expected CPI data from the US on Tuesday, then of course we're likely to see gold prices slide towards the first support at the very least, or even perhaps break underneath this first support. So do take note, stronger than expected inflation data could push gold prices below the first support and at least test the level of $2,000 per ounce once more. All right, okay, so that's what we have for gold. Right, Nick. Okay, let's go back to dollar index quickly. Go back to dollar index. Right, okay. So as I mentioned as well, on Tuesday we've got CPI data coming up in the US. So if we get stronger than expected data, right, this is going to potentially create strong demand for the US dollar, right? Because higher inflation, or rather persistently stubborn inflation data, is likely to keep the Federal Reserve it's likely to cause the Federal Reserve to at least continue to keep rates at elevated levels, right? They may not increase rates this year, but they are likely to hold it at current levels for an extended period of time, right? So with interest rates continuing to remain high, we may see demand for dollar also continuing to remain elevated, right? So higher inflation could cause stronger demand for the US dollar. So we may see, at least for today first, maybe the dollar consolidate around 104, perhaps slide a little bit lower. But should US inflation CPI data come in higher than expected, then of course we're likely to see strong demand for the dollar, and dollar index could potentially rise up towards the first resistance at 104.72, right? So this is a very significant level here, right? We see price running the resistance here 31st of May, finding decent support here on 12th of September. And we can see last week as well, price coming quite close to this level once more and running into resistance. It is also a level that aligns quite well with the 61.8% Fibonacci retracement. Let me try to adjust the labeling for this. It's not very clear. Alright, okay, probably this is a little bit better. So we also see the 61.8% Fibonacci retracement aligned very well with the first resistance at 104.72. Right, so this retracement was found by starting from here, 3rd of October, going down to the low on 28 December. So that's how we found a 61.8% retracement here. Second resistance is this overlap level at 106, right? We can see price finding support here on 31st of October and then running to resistance on 10th of November. Right, we also see a pretty intermediate resistance level here, near-term resistance for the dollar index. So should price break above this near-term resistance, then it's quite likely to trigger a move all the way up to the first resistance here. So this near-term resistance is a pullback resistance level here that occurred on 8th of December, which is at 104.27. We also have an intermediate support level here, or an overlap support level here, right? Price finding support here on 8th of December and then running into resistance here on 17th of Jan till 31st of Jan, creating this overlap level here. And this is also a level that aligns well with the 23.6% Fibonacci retracement. First major support for the dollar index is at this overlap level here at 102.71, which also is also a level that aligns very well with the 50% Fibonacci retracement. And if I were to highlight the second support level, that would be at 102.07, right? We can see price finding decent support here from 3rd of Jan all the way till 12th of Jan here before moving higher, right? So these are the key support and resistance levels for the dollar index. Do take note, we could see the dollar index consolidate at least today around 104, around the region of 104, but on Tuesday we are likely to see a strong catalyst in the form of US CPI data, and we may see dollar index push at least towards the first resistance. All right, so let's move on to the euro. All right, hi XD, I'll cover what's that, Kiwi Cat as well after I do the euro, right? There's a request for, yeah, Nick wanted to look at DXY and euro, and then after that I'll look at Kiwi Canadian dollar as well. US 10 is showing me exactly a picture of gold. Yes, I think you're sort of right. Okay, before I go to, okay, let me cover euro, and then we can take a look at how where the US 10-year bond yield has been moving as well. All right, okay, so similarly with the dollar index being strong since the beginning of this year, we can expect the euro to be sliding lower, which is what we're seeing here. Price action clearly is to the downside. Price is also trading within this bearish channel since 2nd of January. Price has respected the upper trend line and the lower trend line on this bearish channel since 2nd of January. And now price found strong support here at the beginning of last week at 1.0736, right? We can see price running into resistance here on 6th November, finding strong support on 8th of December, creating this overlap level here where price has once again respected and found support here quite strongly before retracing higher. So 1.0736 is indeed a very significant overlap support level for the euro. We've also labeled this as a downside confirmation because we could see the euro range between these two levels, 1.0736 and 1.0820, before US CPI perhaps functioning as the much needed catalyst to drive it in either direction. So should price break above the downside confirmation here, which is actually the first support, we could see price slide all the way down towards the second support at 1.0665, and conversely to the upside, if price manages to break above the first resistance, which we've identified as the upside confirmation, and also that would mean we could see price potentially break above the upper trend line of this bearish channel to signal some sort of bullish confirmation as well. But do take note, the bias for the euro, the overall bias to the euro is to the downside, so we could see prices retrace a little bit higher before stalling and then reversing to resume the downturn as well. Alright, so this is what we have for the euro. Right, okay, so I'll cover US 30, which is Dow Jones 30 as well, but before we get to that, there was a question about US 10-year. Let's quickly look at the US 10-year bond yield on the daily time frame. Yes, you could see, yes, sort of bond yields are moving in opposite directions, right, to the value of gold, right? So with stronger demand for the dollar, typically you're going to see stronger demand for government bonds as well. Oh no, not stronger demand, you're going to see the bond yields rise as well. So with that, you could see it's going to have a negative relationship impact on the value of gold as well. It's more of a inverse relationship, right? As we know, the US dollar and gold prices have an inverse relationship, and similarly, if you try to overlay that with the US 10-year bond yield, is going to likely to show you something similar as well. Alright, okay, let me do US 30, right? Yeah, there's a request as well for US 30. I'll do that first, and then I'll cover Kiwi Cat. Alright, so US 30, so the instrument I'm using here is Dow Jones here, DJ30, that's the instrument I'm using. So if you look on the monthly time frame first, you can see Dow Jones is trading at all-time highs, right? The last previous high obviously was here back in January of 2022. Prices are coming as high as about almost 37,000, but then finally it has broken above this level here in December of last year, and it's been making newer highs since then. So even on the weekly and monthly, you can see how strongly prices have moved. So on the daily time frame here, the first resistance is quite clearly here at 38,770, right? Price has failed to break above this level quite convincingly. Now, why is the second resistance? It's quite hard to identify it now. As I've said, price is trading at all-time highs. Even we tried using some Fibonacci retracements or extensions, but unfortunately we couldn't use any of these levels to help us identify a significant second resistance. So for now, first resistance is at 38,770. Second resistance, not sure exactly how to pin a level on it, so perhaps I'll probably just use the 39,000 as a potential second resistance level. Okay, to the downside, support, we do see strong support here, right? Price running into resistance here on 29th of December and then on 11th of Jan. Then afterwards, finding decent support here on 24th of Jan, 25th of Jan before bouncing higher. So this creates an overlap level here. So this is a pretty significant overlap support level, which is what we're using to identify the first support at 37,825. Similarly, second support at 37,160 is another strong pullback support level here. Right, we can see price finding strong support here on 20th of December. You can even argue here on 5th Jan and 8th Jan, price finding support just above this level, and of course quite clearly finding support here on 16th Jan, 17th, 18th before bouncing higher. So this is indeed a significant pullback support level at 37,160, which is what we're using to identify the second support for Dow Jones. So we've had strong earnings seasons as well. Part of the reason for this strong move. Q4 earnings seasons in the US is currently ongoing. So overall, earnings and revenue have been coming in better than their estimates, of which we are seeing strong rise in overall equity markets as well, right? So do take note of that. We're seeing a strong overall rise in equity markets as well due to a relatively good Q4 earnings season that has been currently taking place in January. Alright, so do take notice at the levels here. We could see equity markets pull back first, of course, slightly, but the uptrend in general for US equity markets is to the upside, right? We are likely to see prices pull back a little bit, of course, but otherwise they are in a strong uptrend. Alright, okay, they will cover oil too. Yeah, that's alright. Let's do to trade an overlap, sir. Can we use Fibonacci retracement alone? Yeah, you can use, well, I wouldn't say you don't have to use the Fibonacci retracement alone, right? But of course, if you do have a retracement level that aligns very well with a particular support and resistance level, then of course, yes, we can use that for sure, right? It doesn't have to be just the Fibonacci retracement, it could be other levels as well, right? Okay, let me do New Zealand CAD and then I'll cover oil. Yes, we'll just have time for that. So New Zealand CAD, Kiwi CAD, let's quickly do that. Alright, okay, so this okay, just let me, this is a pair. Okay, let me just tidy up everything. This was an older analysis. Alright, let's just zoom out. Right, so New Zealand dollar, Canadian dollar. Right, so we saw the New Zealand dollar bounce quite very strongly last week, Friday, 9th of February. We can see that since December, price has failed to break above 83.85. This, I can see this is quite clearly a very strong resistance level here, and also we can see price finding decent support here in January as well at around 85.50. Right. Okay, so let's just do the support quite clearly. This is a strong support level here for New Zealand dollar, Canadian dollar at 81.63. So we'll use that to identify it as the first support. Second support is this pullback level here, right? You see price making a strong pullback here before bouncing higher, 81.11. So that's why we identify the second support. Resistance, right? Could see a pretty decent pullback level here, right? This could be where the first resistance is also. Why is that? Right, you can see price finding strong support here on 8th of December all the way till 5th of Jan. So what was previously a pullback support level could now function as resistance. So do take note, although the Kiwi Canadian dollar was rising quite strongly last Friday, it could well continue as markets open later today. And where you could run into resistance would be around 83.05. So do take note, 83.05 is the first major resistance level for the New Zealand dollar, Canadian dollar. That's why we can expect prices to at least stall around this level here. So do take note of that. Second resistance is also pretty obvious. It's this pullback resistance level here at 83.86. right? So that's how we have identified the second resistance level. Should there be any Fibonacci retracement? Let me see. Start this retracement from here, 29th of December, going down to the low here, 5th of Feb. Right, there is a 61% Fibonacci retracement as well. That aligns quite well with the first resistance. So let's do that as well, add that in. So you can see first resistance at 83.05 is indeed a pretty significant level. So this is an area where we can consider to identify a potential take profit of a level should the Kiwi Canadian dollar continue to rise higher. So 83.05 is indeed a very significant resistance level that aligns well with the 61.8% Fibonacci retracement. I think there may be one more retracement that we can try and use here from 28th of October to here as well, 7th of December. They're pretty much the same level here, so it doesn't matter which point I end at. 61% is here, right? Okay, so we do have 61 here. Is there a 78.6 that we could use? No. So once again, we do see the 61.8% Fibonacci retracement aligned quite well with where the first support had been originally identified, right? So this is, oops, hang on, where's my box? I want this, yeah. So you can see here, this is indeed a pretty strong support zone for the Kiwi Canadian dollar as well. Alright, so do take note of that. We've seen a strong rise in the Kiwi Canadian dollar, where it could run into resistance is at 83.05, which is a level that aligns very well with the 61.8% Fibonacci retracement. Alright, okay, I'll just round up with oil. Yes, I'll just round up with oil. Alright, so this is the last analysis for today. Alright, okay, so I'm on a daily time frame for oil. I'm using WTI oil here. So as you can see, prices pulled back quite strongly on beginning of February and last Monday as well, but then we saw price finding strong support around $72.35 per barrel before bouncing higher. Of course, with the ongoing geopolitical tensions in the Middle East and also the ongoing conflict in Ukraine, there can be flare-ups that will cause oil prices to spike higher as well. So that's what we are seeing. Oil has been pretty volatile, right? It found support in mid-January before climbing very strongly all the way as high as $78.80 per barrel before pulling back sharply as well due to perceived ceasefire talks. There were some suspected ceasefire talks in the Middle East, which means geopolitical tensions was sort of subsiding, combined with weaker China data as well. China being the second largest economy, if they're not growing strongly, if the data out of China is not good, then basically that means their consumption for commodities such as oil would be lower as well. So that's why we saw a combination of these factors causing oil prices to pull back. But then once again, we had geopolitical tensions return to the scene, which has saw oil prices pick up again. So we can see oil has been trading quite volatile and is expected to do so over the next few weeks as well. Alright, so first resistance is quite clear here, 78.82, right? It's a strong resistance level that aligns well with the 50% Fibonacci retracement, and second resistance too aligns quite well with the 61.8% Fibonacci retracement. And we can see price finding strong support here on 25th of August, then after breaking under, finding resistance here, 14th November, 30th November, and once again very clearly here on 29th of Jan. So this creates a very significant overlap level, which is what we're using to identify as the first resistance, which also aligns very well with the 50% Fibonacci retracement. Similarly, for the second resistance, we see price finding strong support here on 13th of October, 26th of October before breaking lower, and then finding resistance here 6th of November as well. So you can see the price action here of this level is quite significant as well, which is why we're using it to identify as the second resistance and aligns quite well with the 61.8% Fibonacci retracement. Right, in terms of support, we see an intermediate support level at 75.70, right? Price running into resistance here on 26th of December. You can argue here again finding resistance here on 12th of Jan as well as on 22nd of Jan. So this was functioning as a pullback resistance level, which is now could potentially function as support as well. So we've identified it as an intermediate support. First support is quite clear. We see a very strong pullback level or swing low bounce here, right? So it's quite clear that this level here is a very strong support. So that's where the first support at 72.34 has been identified. Second support is the strong pullback level here as well at $70.16. Price finding support here at 4th of Jan, 8th of Jan, and you can even argue here 18th of Jan as well before moving higher. Right, and we can also see we have a nice ascending trend line that's supporting price as well. So we are seeing a series of higher lows as well, series of higher lows, higher highs. So it's indicating to us that oil is in an upward trend, although it is very volatile. We are seeing extreme swings to the upside and downside as well. Right, so do take note, due to the ongoing geopolitical tensions and conflicts going on in the Middle East and in the Ukraine, we are likely to see crude prices remain elevated as well, but of course being very volatile as well. So the first resistance is at 78.82. So if we can see prices stay above 75.71, we could see another nice bounce going towards the first resistance, which is an area where we can consider or we can identify as a potential take profit level for WTI oil on the upside. Alright, hi, good morning, Jamilu. Good to see you as well. Alright, okay. So thanks everyone for tuning in today. Right, so we've come towards the end of the session. So do take note. I just wrap up with the dollar index. Do take note. We've seen strong demand for the dollar in 2024 so far. We may see the dollar consolidate for today and for tomorrow as well, maybe at around 104. But we've also got US CPI data coming up. That's going to be a very strong catalyst for price for the dollar this week. So we could see strong demand for the US dollar return on Tuesday, and that's likely going to cause dollar index to push up towards the first resistance, right? So do take note, this is the economic calendar for this week. We've got quite a few important data points coming up in the UK, US, Australia, Canada. But do take note, we've got what I would like to highlight is the inflation data in the US, CPI data on US Tuesday, 13 February. That's going to be released at 1:30 p.m. GMT time. We've also got CPI data from the UK that's going to be released on Wednesday, 14 February, 7 a.m. GMT time. And we've also got UK GDP data on Thursday, 15 February at 7 a.m. GMT time, right? So do take note, inflation in the US has been trending lower, but because we are seeing ISM prices index pick up again, and ISM prices, as you can see, tends to lead CPI data to the upside and to the downside, this could be an early warning indicator that inflation could be returning in the US with respect to CPI data. And similarly, inflation in the UK has been stubborn as well, although it has been retreating from its peak, but is still well above the inflation target of 2 to 3% by the Bank of England. And we've seen quite weak economic growth over the last few quarters in the UK, but now the latest 3 months of PMI data has shown strong expansion, so we could see the latest GDP data come in quite strongly as well. Alright, so do take note of the economic calendar for this week and how it could potentially drive the direction for currency markets, for gold, as well as equity markets as well. Alright, we'll just end off with the ending disclaimer here. Alright, do take note of the risk warning that comes with trading forex and CFDs. They carry a high level of risk to your capital, and you should only trade with money you can afford to lose. Alright, thanks everyone for tuning in today. Do look out for all upcoming webinars by IC Markets for the rest of the week. I wish you all the best in your trading journey, and do keep an eye out on the economic calendar this week, because there are quite a few events that are likely to function as catalysts for the relevant currency pairs. Alright, thanks everyone for tuning in today. Hope this has been a great session, and do look out for all upcoming webinars by IC Markets for the rest of this week. Alright, thanks everyone, and we'll catch you at the next webinar. Alright, there's a question, what is your best pair for this week? It's just a quick one. Most likely I think it's going to be the euro, especially with the inflation data. We could see the euro continuing to fall lower, especially if we get hotter than expected US CPI data on Tuesday. Alright, thanks everyone for tuning in. This has been great, and I'll catch you all at the next webinar. Alright, take care everyone, and have a great trading week.